All right. So the last 24 hours have highlighted something that's sort of a dilemma for investors. Certainly, it seems like for a lot of monetary policymakers, certainly the theorists out there. We're talking about the intersection of this big AI build out, growth, and inflation. I'm going to bring in Jim Thorne of Wellington-Altus. He's their chief market strategist. So, Jim, we get GDP number. It's a respectable number, and it's driven by this, right? The business investments. And you know, and listen, you have a lot of folks who are saying, well, this is also driving inflation, and therefore the Fed should act. But to me, it sounds nuts. Without this, we don't get this, and there's nothing going on the residential side. Should we fire all the construction workers? I don't understand the broad implications of why we can't be building for the future and that this should be okay. And yet this is a reason a lot of folks think war should be hiking rates.
Well, look, we have this old playbook where growth is bad, and that's because economics on Wall Street and the Fed was, and I underline was, driven by the Keynesians. What you're seeing is with the investment on the business side is that it's the early indications of President Trump's supply side policies. And when you shift the supply curve out, you don't get inflation. That's basic economics. And what people have got to understand is that Wall Street is behind the curve in this one point. The private sector is taking over. Bessent has talked about it. Warsh has talked about it. The interest rates that are on the long end are being set because big tech has gone from providing savings for the economy to demanding credit. Rates are going higher. So listen, Charles, the Fed has to cut 100 basis points to steepen the yield curve. This is all good. We are exiting secular stagnation and the liquidity trap that you and I have lived with since the global financial crisis. You and I got to go back to when we first met, back to the 90s and the 2000s when the private sector ruled.
So let's talk about with Warsh thing, right? The market's gone down the first few months of every new Fed chair. And the interesting thing, months to their first hike, they all sort of tried to, for whatever reason, it only took Volcker 2 months. It only took Greenspan 1 month, Bernanke 1 month, Powell 1 month. I think some of them regretted it. And so it feels like the market is also trying to push Warsh around to show him who's boss. I hope he doesn't fall for it.
No, he won't. He won't. He's very smart. He has very good capital markets pedigree. He's not going to fall for the easy out. He's going to stay pat. And I look at the next move in the Fed is going to be down. Okay.
Next move is a cut.
And
okay.
And you need to be prepared for that.
Hey, listen. I hope you're right. And I don't think they're going to hike. I don't think they'll do anything this year. I think he'll get the working groups in place, have the recommendations, reset the whole system. But part of that will be how to measure inflation. And so we had core PCE today, which is 3.3. You know, he already told the Senate that he thinks the Dallas trim mean PCE is a better way of measuring it. That would put us at 2.4%. So when he says that the Fed is committed to their 2% target, a lot of people say he's hawkish. He thinks we're almost there, doesn't he?
Charles, if you use trueflation, we're at 2%. There is no inflation problem. That's why the Fed funds rate should be at neutral, and then let the private sector take over and allocate resources. The era of the technocrats determining where we are going in the economy is over.
Jim, you've been a big advocate of this AI build out from an investing point of view. Some of these stocks are under a lot of pressure. Today, they're exploding. GEV had a monster earnings report and the stock got hammered. Caterpillar's been hammered. But Sanmina up today, at one point it was up $98. Stay the course with these names?
The liquidity event that we just experienced, or the deleveraging event that we just experienced, with people taking leverage and buying stocks. And, you know, Warren Buffett has a great line. If you're smart, you don't need leverage. And if you're dumb, you shouldn't use it. We just experienced a deleveraging event.
Yeah, well,
work your way back in. The names have been identified. Buy low and sell high.
All right. Listen, I guess even if you're valedictorian at 19 in Columbia, you still have something to learn when it comes to investing. Remember long-term capital? Every time we give these brilliant folks a whole bunch of money, they seem to do this. All right, I can't let you go without asking you about the earnings after the close, because I think you like Apple, which has been amazing. It's been absolutely phenomenal. Stay the course at Apple.
I think you start trimming, Charles.
Okay.
I start, I'm right now short term. It's charts are your guide, and yeah, I think people are hiding in Apple because they were confused about the AI trade.
Right.
Yeah. And I think if you got Amazon up there, Amazon's right at the 200-day. I would be buying Amazon. I would be buying the stocks that have been sold down on narratives that are wrong. Yeah. And that's where you need to do your fundamental research and then use the charts and the emotion as your guides of when you enter and exit.
Yeah, and the irony is Tim Cook already told you, because they have to pay more for chips and all these things. I think they're going to start talking about a little bit of pricing pressure, a little bit of pressure there on operating margins. I'm with you. If I'm a shorter term guy, I'm out of Apple, and I'm looking for these names, right, that was plunged to buy on the weakness. Jim, thank you so much, my friend. Hope we see you soon.
Take care, Charles.